Okay, so guys, so today I'm going to share with you 3 types of indicators that you should use or you can use to increase your profits. The first type of indicator I want to share with you is what we call the trend indicator. Basically, when you go to the markets, you see a bullish trend like that, and also you see a bearish trend, meaning a downwards market. At the same time, you also see when markets go through a consolidation, meaning a ranging market. This is when buyers and sellers, they are very indecisive. So for trend indicators, you use them to determine whether are you trading in the bullish trend or are you trading in the bearish trend. So basically what trend indicators allow you to do is to help you determine, what is the strength of the trend. There are many trend indicators. The first one is moving averages. Okay, so a very common moving average that people use is, for example, 100 SMA. Alright, so you put that in. When prices are above 100 SMA, you're trading the bullish trend. When it goes below 100 SMA, then you're trading in the bearish trend. Okay, so another indicator that people use, also moving average, but exponential moving average. So a very common exponential moving average that people use is 20 EMA. Okay, now different people use it differently, so I'm not going to elaborate on that. That's for another video. Basically, EMA, it takes into account of recent prices, whereas for SMA, it takes into account the average of the prices over the period. Okay, so now another trend indicator that people use to determine the trend is force index. Okay, now I'm not going to elaborate too much on how to use each indicator. I'm just going to show you which are the indicators that you can use to determine the trend. Okay, so another trend indicator that's really common is parabolic SAR. Alright, this is the parabolic SAR. Okay, it comes in the form of dotted lines, you can say that. So another very common trend indicator is ADX, or what you call average directional index. Okay, so if you put that in, this is how it looks like. Also, I'm not going to elaborate too much on that, how to use it. But if you want a video on each of these indicators, let me know, okay? Now, you do realize that when you go to trend, another very common indicator here is Bollinger Bands. Now, I wouldn't classify Bollinger Bands as a trend indicator because I feel that it is more suitable to be something else, okay, which I'll talk about later. Of course, the more common ones are moving average, ADX, and also parabolic SAR, and of course another one is trend lines. Okay, trend lines, which is a very important tool you should use. You can choose not to use force index, ADX, parabolic SAR, but trend line is a very important skill you must learn. Okay, especially if you're a beginner, very important to learn trend lines. Okay, basically how a trend line works is that the more amount of times it tests the trend line, then the stronger it is. And of course, the steeper it is, the less significant it is. So for example, if you see a trend line that goes like this, which one do you think is more significant, is stronger? This one, the first one, or the second one? The steeper it is, the less powerful you can say it is. See, the price came back up here, and this one used to be support, now it became resistance. What you can do is that when the price broke the trend line, broke below the trend line, just like this one, you need to wait for it to retrace a bit, bounce off. Normally when price breaks trend line, it would retrace sometimes. Of course, sometimes it won't. Sometimes it's going to retrace. Then it retraces up here, bounce off, then you can be sure that the bullish trend has ended. But if it bounces off a not so strong trend line like this one, okay, by chance it's just going to be a retracement, a temporary market correction in a bullish trend. Okay, now so the second type of indicator is what we call the volatility indicator. Now you realize that in the forex market, you have a bullish trend that goes up just like that, but along the way you'll find that certain phases, the prices move and spike and make large movements like this, okay, like this one. And on certain phases, you realize that the prices, they don't really spike a lot, it's just small candles, okay, like this part over here. Okay, you see very small candles. So you can say that this kind of market is not that volatile, whereas if you look at this type of market, it is more volatile. So of course visually you can tell just like that, markets are volatile here, markets are not so volatile here. But if you want an indicator to help you determine how volatile it is, there are two main types of volatility indicator. The first one is your Bollinger Bands. Okay, normally this is the default setting, so I click OK. Now realize that when there's a massive spike in the market, the Bollinger Bands would widen. When the markets are not so volatile, you realize that the bands tend to narrow down. You can combine this with your trend indicators. What happens normally is, before a major breakout to the upside or to the downside, the bands would tend to narrow. The bands would tend to narrow and narrow and narrow, and this is when you can prepare to trade a breakout. Okay, so the next indicator that you can use to determine volatility is using ATR. Okay, now some people use this to determine their stop loss. So if you want me to do a video on this, also let me know that in the comment section below. Another use of Bollinger Band is to help you pick a currency pair that you are comfortable trading. So what you can do is that you can maybe zoom out a little bit and then you test different currencies. Which one tend to have a wider band most of the time. Okay, then the next type of indicator is momentum indicator. Basically, it tells you how fast the price is moving, whether the price has enough momentum for it to continue on a bearish trend, okay, on a bearish trend and on a bullish trend. A lot of people, they like to use momentum indicators as confirmation for their chart pattern, for their candlestick pattern, and I find that that is enough. So some of the momentum indicators, most of them, they are called oscillators, and the more common one, stochastic oscillator. Okay, so this is how it looks like. I've already done a video on this, you can go and check it out. And also another very common one is RSI. Now I realize that there's a bit of similarity between stochastic and also RSI. Now why is it called oscillators? Because it oscillates between overbought and also oversold levels. Basically it's like a swing, okay? It goes up and down, up and down, up and down. And very often times you realize that one indicator goes to the oversold level, the other stochastics will also go to the oversold level. You realize that? You see? Oversold over here, oversold over here, overbought over here, overbought over here, overbought here, overbought here. This is why I tell people don't use too many indicators on your chart, because most of the time they just tell you the same message. So putting so many lines is just going to confuse you. Basically, what you need to do is just pick one that you're comfortable with, then go with that. Now another very common momentum indicator is your MACD. Okay, MACD. Now, MACD, I'll say, is a bit different. You have your signal line, you have your MACD line, you have your histogram. It's going to take a little bit more time for you to learn, but basically the principles is the same. It measures momentum. And also for stochastics, RSI, MACD, you can use them to spot divergence. What do I mean by that? Let me give you a good example. Okay, so basically what you see is that there's a bullish trend over here. Okay. So prices are making higher highs, higher lows, but then you realize that your stochastic is making lower highs. Okay, so this is what we call negative divergence, and at the same time you see your MACD histogram, it is going down. Just tell that, okay, maybe, not guaranteed, but maybe the bullish trend is going to end, so you better take some profits out, and then you better get out. And the way to use stochastics and RSI properly is to make sure that it goes from overbought back to the neutral level, which is the middle part, okay? Goes from overbought back to below 70 for RSI. You see there's an overbought level here, but price can still continue going up. And you realize that in a bullish trend, price tend to go to the overbought level very often. So when you're on a bullish trend, what you want to look for is oversold levels. That's where you can go in on a retracement. Basically, in a bullish trend, ignore overbought levels. In a bearish trend, ignore oversold levels. The thing is, when it comes to these kind of indicators, they work better in larger time frames. Just like any chart pattern, when you see a chart pattern on a larger time frame, it would be a stronger signal as compared to a lower time frame. So if you're using small time frames, you know, like 1 minute, it's going to give you a lot of false signals. And it's just a lot of noise when you go to a small time frame. So I would prefer if you use like larger time frames, okay, the H1 time frames, the H4 time frames, and also daily time frames, and you hold your trade longer, and also you don't need to monitor that often. But most importantly, don't use too many indicators. I know I've shown you a lot. I show you all these indicators doesn't mean you need to use all. You just need to pick 3 to 4 is enough. Maybe 1 from volatility, 1 from trend, 1 from momentum, and that's enough. Minimum 3. Then you add that with price action, then you're good to go. trading shouldn't be complicated. Okay guys, if you want to learn about stochastics, I'll put it in the end screen later on. So with that, I'll talk to you in the next video. Bye.